Hey, we're going to get started. Dan Williams here. Thank you so much for joining us. And if you're watching on recording, thank you for watching it. We're going to go through this one real quickly. It's our quarterly case. We look at a real live case of someone that my team and I have helped with a HECM/ reverse mortgage. And this one's a good one. So I'm excited that you're here. So let's talk about first that my designation, I shared with you this last time, the certified reverse mortgage professional. There's only 208 of us nationwide. It's a very difficult designation to get. Trust me, I studied a ton to get it. And it really raised my level of understanding and application within the reverse mortgage world. So, quick background on me, coming up on 20 years in this business. I think I'm a year and a half away. Over 500 mortgage transactions over the past 5 years. And then we've also done over $200 million worth of mortgages. And as importantly, I'm C2 reverse certified. C2 is where I hang my license. They are our broker. And I've worked with them for well over a decade. They have a very difficult and stringent process to get certified to even offer reverse mortgages. And I love that fact. Our C2 group is amazing, very committed to self-education and knowledge, as well as C2 providing ongoing education and resources as well. So first, my quick refresher, and I always start every event and meeting with this. A reverse mortgage is just a mortgage. An important distinction. You can refinance it. You can buy a home with it. You can make a payment on it. It's just a mortgage. But the one difference, you have to live in it. You can't have a reverse mortgage on a home that you don't live in. This is the case today. It's called the relocation opportunity. And the couple was 70 and 72. They had an existing mortgage on their primary residence, but their portfolio was shrinking and their cash flow was slightly negative each month. Those last two, the portfolio shrinking and cash flow negative, very bad. So what we did, we took a look at the issues at hand, and obviously the assets under management were shrinking way too quickly. They were going to run out of money in about 7 years based on their spend rate and their obligations. And not surprisingly, the real estate, more importantly, the equity inside their home, was by far the largest asset class in their portfolio. So here's the problem. This client was referred to us by a financial professional, and they were having sleepless nights, worried about running out of money. It was their forever home. They didn't want to move, but they had a couple of opportunities here. The loan balance was $312,000. The principal and interest payment was $2,450, but the value of their home was well over $1 million. It was about a 1.51, I think, ish when they sold it. So obviously, this is a huge part of their investment portfolio. They needed to supplement, increase their cash flow. Their investment account of 280,000, as I described, was probably going to run out in around 7.5 years. And then the refi, if we were to stretch that mortgage payment out again over 30 years, it would save them money, but it was only going to save them $550 per month. So what we want to do is as proactively as possible is not have them wait to make an important change. We're not going to use this as a mortgage of the last resort. We're actually going to use it as a strategic tool. And then financial assessment. This was a big one, and we've talked about it in past previous cases. Financial assessment is really important. So real quick refresher on that. Basically, you can see their income, expenses, some other things here. And this is just a real short view of what we call residual income. You can see it right here. So they were able to qualify based on this test. And we've got there's a cash flow test. So it kind of is a mini abbreviated P&L, the financial assessment. So you don't want to wait until they're out of money, they're upside down, things are really ugly inside the house, because they can have $2 million of equity in the home. But if they don't pass the financial assessment, it's a problem getting a mortgage. So years ago, you really kind of didn't need to qualify for a reverse mortgage. Today you do. Okay, so we looked at a couple of things. We wanted to eliminate that mortgage payment to increase cash flow, create a line of credit for emergencies if possible. And their other was their healthcare concerns. As they're aging, they're wondering how they're going to pay for what may be out of pocket on the healthcare side. So we put the HECM in place. We increased their cash flow by 2.15 to 2159. Excuse me. The solution was to pay off and stay in their current home. We could pay off their mortgage and we could create that line of credit if needed. We could do some home repairs and we could, any additional cash flow they could send to their financial advisor. Here's what got interesting. The solution number 2, they could sell, I shouldn't say they, she could sell her home. It was a widow, or excuse me, that's not right. I'm thinking of another one. It's the couple, they could sell their home. They're going to net $900,000 after taxes, and they're going to purchase a new home with the HECM mortgage. So this was an intriguing one, especially because they had, moving from Pasadena, they had kids and new grandkids in the Palm Desert, Palm Springs area. So with this solution too of selling the home, they identified a new home that cost $750K. They put a $455,000 down payment down, which was required based on the math of the reverse mortgage. So the math is based on interest rates and age. So they put $455,000. They have no mortgage payment. Remember, there's no obligation to make the payment on the reverse mortgage side. So they have taxes and insurance and HOA, since this is a condo. They were then able to put the balance, $445,000, back into the investment account with their financial advisor to really juice up their savings. So the software that they used, they had a success score of like 25, 26% of success on their current plan. This moved them to up over 80%, 84, 85%, using Money Guide Pro, to what their success rate would be with these additional funds. So here's what it looked like at the finish line. Sold their home, downsized near the grandkids. It's a smaller home, not a 2-story home, a 1-story condo as well. So there's no yard work, there's no upkeep, and their obligation is much reduced compared to the big home in Pasadena. And we were able to get their retirement account up in a range that really makes it more comfortable for them cash flow wise. Big difference. So their outflow goes to $950 a month total. So they have their Social Security to cover the $950 and more. They're not digging into their investment account. They're going to let that grow. Now, because we put down the minimum required, there's no line of credit. But I do want a quick refresher here. If you have this, you're able to create this line of credit, it grows at the note rate of the reverse mortgage. So if you have $100,000 line of credit that's unused, after year 1, it becomes $106,000 and grows from there. Now, what they can do is make a payment if they decide, and that automatically creates a line of credit. So if they want to do that, they can. They probably won't in this case, but remember, that's always available. If you're making a payment, you can help that line of credit increase even quicker. So real quick, before we end today, I know this is a quick one. Please ask me about the free membership to Financial Experts Network. Tom Dixon and his team, it's an amazing resource. It's no cost to you. You just let me know if you'd like to have it. And Tom does 2 to 3 webinars per week. That's right, 100 to 150 webinars a year. Most are approved for CE type credit, whether it's American College, CFP, etc. And then I can also provide you a 15-minute video Tom did on modeling reverse mortgages inside of Money Guide Pro if you use that software. Finally, check out my website, which is sandiegolending.us/reverse. All kinds of quick animated videos, those 90-second videos. There's other resources available there. Once again, it's at no charge. I'm here to help. Please let me know how I can help you and your clients. If you want to schedule a call with me to go over some of the basics of the reverse mortgage, I'm happy to do that as well. So once again, thank you so much. I want to leave you with this. what I would suggest, and I've had a lot of people really enjoy this process, let's model three different clients in your database. Model one, who you think can benefit from it. Model one, you don't believe it could help. You'll be surprised at what you may see. And then model one that has a mortgage and is age 65 or older, maybe even closer to 70. And it's fascinating to see how that can impact them in a positive way in retirement. Last thing before I let you go, listen to the pain points of that client near retirement. Maybe that's someone who wants to retire or is having health issues and needs to retire. When they say, hey, when I finally pay off this mortgage, I can retire, let's talk. Because that may be someone we can change their life for the better and get them into retirement, spending more time with their family, their kids, and grandkids than they believe was possible. So thank you so much. I'm here to help if you need anything. Otherwise, have a great day. We'll do our new quarterly case probably in January. We'll let the holidays get past us and we'll talk then. Thanks.